All right. So today we'll be continuing our F3, but before that, we just do the overview of pre-scene. So what I'm thinking today, just to make all of you interactive, we'll make it simple. Okay. And I hope you have already done the analysis of SWOT, PESTEL, and stakeholders. So we'll do the same thing. Uh, we'll do the SWOT first. So I want each one of you to give one strength, weakness, opportunity, and threat for Robobryce. So 4 points from each one of you, and nobody should repeat the previous person's points. For example, somebody says as simple as listed company. So that strength you should not repeat. Okay, so we'll end up covering almost 10 strength, 10 weakness, 10 opportunities, and 10 threat. Second, we'll do is one stakeholder and their needs. Okay, so we'll finish this in 5 minutes. Then we'll jump to F3. Is it okay? Is it okay? Yes, no, anybody?
Yeah.
Okay. Great. Very simple exercise and good point of revision. So we'll start, Vinthya. Simple points.
Okay. So one of our strengths seems to be we are quoted in the stock exchange, and our stock exchange is very active and well regulated. And the market for warehouse automation also is rapidly growing. One of the main weakness I found in the company is the board is imbalanced, and one opportunity would be to uh, expand into cold chain and e-commerce markets more, or else you could expand the product range, the environmentally friendly product range. And threat, the principal threat for our company is health and safety, or falling behind in innovation of new products, catching up with the technology.
So this is an opportunity.
Sorry, which is
Sorry, technology. What did you say? Can you please repeat?
falling behind in catching up with new technology.
That's a threat you are saying?
Yeah, I'm telling my threat. An opportunity would be expand into environmentally friendly products or services, or expansion into cold chain and e-commerce markets.
Okay, good job. If possible, when you are giving opportunities and threat, you can make it more specific, like exactly where. No need to be, ambiguous. For example, we are saying falling back
Yeah.
of the technology is a threat, but we have to very specific. Let's say threat, we can say PowerBoard is focusing on autonomous because they have seen, and we can also see the demand for that products going on increasing in the market, and we are still doing non-autonomous. So is it that we are wasting the energy? Shall we just put all of that into autonomous product as well, like
Got
that?
it.
Okay,
Okay, then
next.
I'll say that we've helped the Tesla and government in opening the lights out warehouse. I would say we could focus more on that. That could be an opportunity for us.
Okay, very good.
Thank you.
Next.
Yes, strength, I would say, uh, we've been in the industry for the last 17 years, from 1952. That's one of our strength.
Okay.
And then a good R&D department. That's also a strength. And when it comes to the weakness, it's weakness, decline in our share price.
Okay, makes sense.
And opportunity, I would say, we have recently provided the light out warehouse to the
No, that
Tesla
is
and food.
done. Okay, you can say that if you're looking
So,
from other.
like, we can provide that to the other customers as well.
That is a repeated point, Jitu. What else opportunity?
Yeah, the opportunity would be the forecasted AMR growth.
Okay. So we can focus more on AMR, and we are one of the
Yes,
pioneers in
it's
technology.
good. It's gonna be around 4 times increase in the demand of AMR in the next 6 years. So that would be a good opportunity for us.
Right. Okay, makes sense.
Then threat, high exposure to the IT cyber risk, because all of our AMRs and all of our products are related to IT and technical side. So high exposure to cyber issues, cyber attacks.
That's the threat. Okay.
And we can say maybe the low share price is also a threat for us.
Low share price. I mean, that will be again very confusing to say like this. Why you can say raising finance from the market can be a threat. One of the reason
Yeah,
maybe because low share price.
low share price. Yeah.
Okay, good. Anan has put something. I'll just read out for others. So members like Eva and Imon bring hand-on industry experience because of their experience in logistics and production. Okay, so there is an opportunity for logistics that will be related diversification. You can use that. Weakness: lack extensive experience in autonomous technology. Yes, we have only few people who are actually expert in that field, like AMRs. Opportunity: Nigel international consulting experience can be leveraged for potential global expansion and collaboration with manufacturing companies worldwide. Yes, this person has been part of a lot of companies and worked around the globe. In fact, that person skill can be used if we are exporting our technologies also. Threat: the reliance on manufacturing and logistics sector exposures RB to economic uncertainties. Yes, we are not an independent industries, so we are dependent only on one sector. We have discussed this previously also. That shall we diversify? Okay, good job. Next.
I would say for this trend, we have a good talent pool on board, and in employees as well. We have good, well-skilled employees and all. And the weakness is we have a high gearing debt, so we might not able to get easily like the loans and all. And we might ending up paying more interest on loan if we go with the debt. Then opportunity is expanding in a new developed countries where we can expand our business, which brings many new opportunities by product development and market development. But I would suggest first market development would be benefit in opportunity, and threat would be, I guess, health and safety, as Vidya said. And I guess so cyber security as well, because as far as I can see in present, they haven't mentioned much about internal control, mostly for the cyber security, and we don't have any IT person in board as an NED or executive board. So I would say the threat would be also cyber security.
Cybersecurity is repeated. Any other threat, Divesh?
I will think and I will let you know. I need to little bit think.
Okay. Going out of innovation is biggest threat for us.
Oh yeah, that would be. Thank
Okay,
you.
but I want one more from you.
Yeah,
Once
I
everyone
will
is
think and let you know. Yeah.
okay. Next.
Strength could be that this industry is growing really fast, and so the need of these products and this industry is growing every single day, so we have the opportunity to grow. Weakness could be the low cash balance.
Low cash balance. Yeah, good point.
opportunities could be the tie-up that we can make with the universities and train more staff, so we can like train them as per our needs and what we want the potential employees to be good at, so that we don't struggle hiring any staff that's not efficient in doing their job. And threat could be the competition that's there in the market, because we could just be somebody could just acquire us.
Okay. Divesh, you want to say something?
Yeah, I just found another thread that, as they mentioned in the news articles, the game theory that supermarkets start price wars, so it might affect on not directly but indirectly we might face some potential threat on our product as well. So I guess so. Is it right or?
Yes, it makes sense. A lot of people can even reverse engineer our technology and copy it. So we can, when you think of threat, I mean, we are not going in mitigation, but you also should have on your back of mind how we'll take care of it. Let's say companies and other people are re-engineering it with a very minor change. So what we can do? Maybe patents and legal team is fine, but people are very clever. They can just change a very small part of it. There is always loopholes in the laws. Okay, next.
The strengths for the analysis of Robobryce will be like Robobryce have opened a new retail food warehouse layout system where there is no need of any staffs to maintain and all. Only they like for maintenance they need staffs and it is autonomous. So this would be a strength for the Robobryce. And weakness would be like Parvot will be a competitor as both the company is working on autonomous mobile robots. And opportunities, as we can see the graph, it's been autonomous mobile robots is uh, like upgrading more, like it's developing in different countries by 2030. So it will be a good opportunity for autonomous mobile robots to enter into different countries and all. And the threats like fraud, stealing of the equipments and business inventory of the personal users and all.
Sorry, what's the threat, Harish? Can you please repeat?
Like stealing the equipment like in the warehouse and business inventory for the personal use.
I didn't understand. Can you please repeat?
Like stealing of equipments and the business inventory for the personal use.
Right. So is it a threat or weakness?
Like
So the primary difference between threat and weakness is threat is external, weakness is internal. Strength and weakness are internal, threat and opportunities are external. So if there is fraud of stealing and all of this happening, that means we have a weakness of internal control, weakness of risk management, all of this.
okay. Like the
Threat is external. External is also, we can say, uncontrollable.
like what about the health and safety concern for workers?
That's also internal,
Okay.
because it's our workers, right? If you are thinking about
Yeah.
other workers, then it's a threat. If it is our employees, can't you control it? Isn't you have the power and authority to make the policies, internal policies?
Yeah.
Yes, we do have.
Yes. I mean, what about the Darlan? They do have low wages of I mean,
That's an opportunity which we have already utilized.
okay. So I'll go through it once and then I will just
SWOT was also there in the Kaplan family ticket, which I shared with you guys. This is very basic. Okay. Next. Anam, you can put in chat. I think rest all are done. Okay. Any confusion with anyone to understand SWOT and why it is important?
No, it's good. No, it's fine.
Okay, great. So please make your entire analysis and share on the group. Secondly, we'll start with the stakeholder quickly. I hope this is even easier. Just one stakeholder. What is their need and expectations from us? Okay, who will start? Aditi?
Yes. Stakeholder, government, and their expectation is for us is to pay the taxes on time and follow all the guidelines and rules.
Okay. You can even say high or low power. So government, high power, and these are two expectations. There can be more also, but primarily these two. Okay, good. Next.
I would say competitor because they always want to see if our companies are doing ethically or not, or if they are taking any steps particularly or not, or are they developing new thing, and they want to make sure that every company working like ethical way, and them interest would be high, but the power would be low. I guess so.
That's true. But one answer is missing, Divesh. What is their expectation from us?
That's I just said that a competitor will expect from us that we are working ethically, like we are not doing like dodgy sheets or like Volkswagen, which you gave up in the past classes example. Like Volkswagen was find out for in USA and they were selling like a diesel car like that. That the company wants us to do it like an ethical way to do a business. I guess so.
Right. Good. Sometime competitors might also expect us to partner, be a part of the union. If there is something against the entire industry, then we all have to come together.
Thank you.
Hanan is saying trade unions are stakeholders. Trade unions may be interested in Robobryce treatment of its employees. Yes, maybe unions internally. Any good company will doesn't want to have a union in their organization because there can be a headache. That issue is happening with Amazon also. But there can be some NGOs who are external to us who can motivate people to have trade unions and they'll support them with the legal support or things like that. Ultimately, their expectation is better treatment for the employees, job security. Okay, next.
Can I say research institutes because they would expect us to partner up with them, give them new courses, or ask for a donation, keep them in loop regarding new inventions, or take their people into our company, things like that, because we are mainly dependent on R&D too. So they are also a stakeholder, I believe.
Yeah, we can say that for university also. They have
both.
this. The only problem here is about the confidentiality. If you are sharing with them, if their people are coming with us, we have to take care of the confidentiality.
Not necessarily. We could handle this two ways. Either share our new invention with them and develop it, or get in touch with them and get along with them, collaborate, and find new innovation together. So this goes both ways, is what I believe.
Yeah, it goes both way, but either way should be confidential. Imagine other competitors also approaching them.
Okay, got it.
All right. Next, Harish.
Yeah, the Tasteland and Darland auditors needs to ensure the financial statements are reported as accurately as possible. The financial statement, I mean.
So this will be our own employees, right, who will report the financials?
Yeah, like that would be reportedly accurately, like the financial statements and all, like whatever the taxes they are paying, and
Okay.
that should be reported correctly.
We can say this for our own employees. That is
Yes,
expectation of company towards them. But what is their expectation from Robobryce?
their expectation. Right.
Sometimes the question can be confusing even in exam. What question I asked and what we are discussing is stakeholders' expectation from us, not our expectation from them. You're getting the point?
Yeah, I got.
Simple salaries, job security, growth opportunities, flexibility at work. Any employee will need these basic things. Maybe some specific things for the job, but the basic things will always be there.
Yeah, I got.
Jitu,
Sorry, Miss, I missed few points. So can I say any stakeholders or?
yeah,
Mm,
any stakeholder.
yeah, I would say suppliers. Oh,
Okay,
sorry,
supply.
customers.
Just suppliers. What is the expectation of any suppliers? Just logical
Long,
point.
long time relationship.
Very good.
Then the flexibility in the payment terms or
Very
short term, short credit periods.
short credit periods. Okay. If they're giving us in credit. Okay.
Mm, yeah, that's a normal expectation from suppliers from us.
Okay, good. Some suppliers may also expect us to give us certain data so they can improvise and provide a bespoke service to us.
Yeah, like customization or
Yes. Anyways, good job, guys. So please make this in writing and share on the group. So we'll continue. We have to start with the dividend policy. We have discussed the definition of dividend yesterday also. I'll just start again. What is dividend? Dividend is the share of profit distributed among the owners. The share of profit distributed among the owners. Can we say the payment made to the banks are dividend? No. It's a finance cost. It's not dividend. It's not the share of profits. They are not the owners. Is dividend mandatory to pay by legal? No. But is it paid mostly or is it ethically expected? Yes. Especially companies who are making profit, who are matured, they need to pay dividend because the primary aim of any investors, why they invest money in any public company? To earn profits. So we have to justify that. We have to pay for it. Innovative approach, absence of client, joint venture, recycling of robots will be challenging. Yes, Aram, that's true. Okay. So back to dividends is the share of profit, which is a ethical responsibility, we can say. Okay. But it's not a rule or it's not fixed that this percentage you have to do. But indirectly, there is a lot of pressure. Let's say our computer power robot was paying 40% and we are paying 20%. It would have been a problem. Now they are also paying close to 20%. We are also paying close to 20%. So it has not been a bigger issue. But maybe this was one of dividend, we both have paid less, or we have been paying 40, 50, or maybe this has been an average. We don't know. Okay. So there are a number of effect or number of things need to be considered when we are deciding the dividend policy. Dividend is a very important part of financial strategy. What are the three pillars of financial strategy? First is your investment, what investment you want to do, what you are saying yes, what you are saying no. Then how you are financing it, debt, equity, retained earnings, whatever. And the last one is dividend policy. Why this all three are important is all three are interrelated. If you see, if you are paying high dividend, you don't have much retained earnings. If you don't have much retained earnings, you cannot go for certain investments. Okay. So even if the question is not specific to one of the pillar, you can still connect to the other two pillars because of the connectivity. Okay. Now, what are the things that can affect the dividend, or we can say a policy? You know, if there is a new chairperson, new CEO, the policy can change. This is constantly changing. Every company has a different policy, and if you see, they'll attract same type of stakeholders. Sorry, the shareholders. There is one company called MRF in India. They usually buy back shares, and they have not giving any rights issue or anything. They are one of the most expensive share in India. It was around £1,000 2 years back. Now it has touched £1,500 per share, almost around that. So in that, and there are companies, if I convert to pounds, they are just having £2, £3 per share. So when we keep the pricing like this, we attract different kind of shareholders. Maybe in MRF you'll get rich people, and other companies you'll get not so rich people. And MRF is attracting people for long-term holding. Even there, if they don't pay a dividend, the shareholders might be happy because they are already rich. But in other companies, there may be a retired couple or retired people who are looking for this money to survive. Okay. So directly, indirectly, we will accumulate shareholders of similar type. Right. You know, indirectly as a person also, if certain person's attitude is that person is introvert or extrovert, you know, they will attract that kind of people. Even if you see it logically, same thing works in every aspect. Some people are risk takers, so they'll go into the area or the business or some kind of things, which is very similar. Same thing happens in the business also. However, for our understanding, we cannot just say that our our shareholders are maybe rich or they're completely depend on that. When we are making a policy, we need to think that some of them will be depend on this completely. Some of them are investing it for the long term. Some of them are ready to invest for the medium term. So different kinds of shareholders we have. Considering that, we can have a dividend policy. On the top of that, we can even consult to majority of shareholders. What is their expectation? And if we came to know that majority of the shareholders are happy and they want long-term returns, they're even ready to compromise, they're happy with zero dividend also, then it can motivate. Or vice versa. If majority of shareholders are saying, you know, we want to have dividend, whatever is the condition, you can even take loan and give us, but it should not disturb because majority of them are dependent for their living expenses. So that will also motivate. And ultimately, we have committees which are headed by the non-executive directors, and non-executive directors' primary responsibility is for the shareholders. So through them also, this policy will be influenced. So in this chapter, we are not talking about what to follow, what not, because it's not you know, as simple rule, or it cannot tell you that 2 + 2 is 4. You just go with that. No, it's a art. Okay, art of maintaining the relationship. What are the key factors? So once we'll discuss this chapter, we'll try to see what is a good policy for Robobryce, or what can be the changes. All of you can have a different approach, and that should be fine. So first thing, the interest of shareholders. That is also known as clientele effect. Clientele means what? A group of clients. Clientele effect. Different tax treatments of dividends and capital gains and transaction cost on share dealings. Shareholders concerned as to how the return is delivered to them by the company. So it's not only about sharing the profit, but how you are sharing the profit. You know what we can do? Imagine in test land, if we are giving dividends, is 25% tax, and if people are selling their shares, it is 15% tax. So what the shareholders will want? They will sell the shares, but the problem is If they keep on selling the shares, the share price or the share holding will reduce, and ultimately it will finish. What company can do cleverly? They will give free shares. It is also known as scrip dividend, and that free share they will sell it. So their composition of share is also there. Plus, they have saved 10% of the tax, isn't it? Make sense? So, like this policies also will make a difference. Thus, company should follow a consistent dividend policy. When they talk about consistent, means any policy you are following, but be consistent, because tax rules will not change normally. Even people who are holding will not change. The clientele, the majority of clientele will not change every year. Then there is another argument of bird in the hand argument. So what it is saying is there are people who are risk averse, or who are not risk seekers, I would say. Not averse, but not risk seeker also, or heavy risk seekers. If we have earned certain profits, there is an opportunity to invest again, then double it, triple it, increase the profit. But there are also people who understand, maybe if we go for greed, whatever profit we have earned, that can also become zero or can go in loss. So they have used the technology bird in the hand. The example is or this terminology is motivated from jungle. Somebody has caught one bird. Now they are even greedy enough to get one more. So there is also a risk you can lose the first one. So that is bird in the hand argument. Just be happy what you have won. Don't be greedy to get more. Or don't take too much risk. Otherwise, you will lose this one also. So some may find capital gains more tax efficient than dividends. Other investors will avoid transaction cost. Despite all this, investors generally have a strong preference for dividend. One of the reasons why they have strong preferences, dividend is certain promise of uncertain future dividend. Second, we have M&M theory. What M&M is saying, most of the point where M&M is saying is not relevant to the real world, because they have not considered, or it is not relevant to the changing rules, or I would say the legislation of the countries. What this guy is saying, as long as the company continue to invest in positive NPV, the wealth of shareholders should increase, whether or not the company makes dividend payment this year. So this is a fact that's true actually. If you are just investing all the profit back to the new profitable projects, ultimately the wealth of the shareholders will increase. How the wealth will increase? There are two ways. One is increase in share price, second is dividend. So if you don't pay dividends and share price is increasing, ultimately they are becoming rich. But the problem here can be, if they want to earn the profit, they need to sell the shares, which is not the case in the dividends. The M&M argue that shareholders can manufacture a dividend policy irrespective of the company's policy. So they are saying, let them manufacture their own policy. Whenever they need money, let them sell it. Our job is to just increase the share price. M&M claim that shareholders are indifferent between dividends and capital gains, and so the dividend policy that the company pursues is irrelevant. So this fact is actually not true with the current scenario. Why? Because the tax is different. But dividend tax is different and capital gains tax is different. Is it making sense what we are discussing? Okay. Next is signaling effect. Whatever we are doing will give signal to the stakeholders, not only to the shareholders. Maybe the shareholders are concerned directly, but there are other stakeholders, let's say suppliers. Even supplier wants our company to succeed and keep growing. Then only they'll get business. So signaling effect. If you pay zero dividend, maybe company has money but they're investing. So they decided to give zero dividend or no dividend. But somebody will think, okay, maybe company is going for bankruptcy. They're having financial difficulties. Therefore, they are not paying. So this is like a reputation. What people will think. We have to consider that. It is widely believed that there are two very strong dividend signals. First is a reduction in the dividend per share. How much you are doing. Why? Because they'll think company is in financial difficulties. Second, failure to pay out any dividend at all. Signal that company is very close to receivership. Especially matured company, if they are not paying dividend, people think, they're close. They're closing down soon. Thus, the company must take a great care when setting dividend levels and ensure that the market is kept fully informed of future prospects. So, if you see in investment financing a dividend, one of the policy which should be a very long term is dividend. Investment can keep on changing. We can do something for the short term, something for the long term, but dividend should usually be done for the longer term. Why? Because of the signaling effect. Just because of wrong signals, our share price can fluctuate or go down, eventually reducing the value of the business. Then fourth, very important key factor is cash needs of the entity. Let's say we don't have a lot of cash at bank and we feel like we can have problem with working capital. So it's not good to pay out dividend. First, we have to see the primary working of the business. So that will come under the cash needs of the entity. It is important to consider the impact of investment and financing when considering dividend policy. As we already discussed, both are connected. Different types of business will have different cash needs. We'll have to set the dividend, investment, and financing policies accordingly. For example, small companies struggle to raise finance. Struggle to raise finance means through banks, financial institutions, and small company might not be listed, so they cannot issue bonds. So its cash needs need to be restricted by number of dividends. Second is growing company. Usually growing company, they themselves need a lot of money. And for them also, they cannot issue bonds, they cannot get a lot of finance, so they'll try to retain. And in fact, growing company will attract similar type of shareholders. Similar type of means they are working professionals, they are just investing their savings here. They are not looking for immediate gains, but they are looking for 10 years, 15 years, a longer time period. Then mature company like us, stable company might well be cash rich, they have to be cash rich. The logic behind is they have survived for so many decades and they are one of the industry leader or they have a good amount of market share. So it is understood that they should be cash rich. If they would not be cash rich or if they would have not doing something good, they would not survive because the market is so competitive. Whichever industry go, those who are surviving means they are doing good. In which case it might be able to afford to pay out large dividends without compromising its internal cash needs. What are the internal cash needs? Working capital, investment, financing, capex, opex, capital expenses, operating expenses, all of those. So these are the primary key factors that should be considered before selecting a dividend policy. Do you guys think we missed something here? There should be any other factor we should consider? Okay, I'll give one example, then you can think. Industry average. They have not talked about it. Industry average. What is that industry paying in our country in Testland, and what is that industry paying globally? For example, automobile industry. Automobile industry in UK, how much they are paying dividends, and automobile industry in Europe, Asia, or entire world, what is their average? That can also be linked to signaling effect also. Anything else? Am I audible? Hello? Okay. Thanks, Aditya. Other key factors can be the previous dividends, the previous policy. Can you ignore the previous policy?
No.
We cannot. Imagine till last year you are paying 80% of the profit as dividend, and this year you are saying let's make it 20%. So that will be a very big shock for the shareholders. If you want to reduce, there is a way. From 80 you reduce to 70, 60, 50. Slowly you can go. Okay. I hope you guys have understood the key factors. There can be some more as well. Then dividend policy, they have given certain examples, or basically I would say the four type of dividend policies which are usually practiced. Again, we are not bound to follow this. Okay, it's not an obligation for us, it's just a suggestion. First is stable dividend policy. What does it mean? Paying a constant or constantly growing dividend each year. Let's say we have paid 20%, the next year also will pay 20% or 21%. Or basically here, when we say constantly growing, it is with the number. If we have paid, let's say 200 million, next year we'll pay 220 million. Then next to next we'll say 242 million, 10% increase. Or let's say 5% increase. Or certain companies will increase according to the inflation rate. If inflation is 7%, we'll do 7 or 8%. So what it does, offers investor a predictable cash flow, reduces management opportunities to divert funds. This is a downside actually. Why it is a downside? Because whatever is the profit, you have to pay some part of the money always to the dividend. Maybe this year profit was good, so it was 20%, but next year your profit reduced. The same amount what you paid last year has become 40% of the profit. And this strategy works well for mature firms with stable cash flows. Second is constant payout ratio. Paying out a constant proportion of equity earnings. Here I would say percentage is better word, proportion. 20% of profit. Whatever is coming, 20. It might be 200 million, 400 million, 600 million. If profit increase, let them also enjoy. If profit decrease, let them also sacrifice. So what we have done here, simple link between earnings, reinvestment rate and dividend flow. But cash flow is unpredictable for the investor. Why it is unpredictable? Because ideally it should increase by few percentage, but sometimes let's say COVID happened, so that time our proportion will be very less. Gives no indication of management intention or expectations. There is no signaling effect, or there is minimum signaling effect. Third option is zero dividend policy. Maybe it is motivated by M&M theory also, or it is more suitable for the growing companies. All surplus earnings are invested back into the business. Is common during the growth phase. Should be reflected in increased share price. But however, here the shareholder expectation is okay, you're not giving us profit, but you should invest in profitable ventures, profitable projects. And if you're investing there, automatically the share price will react to it. So this will keep them happy. Okay, if I need, I can sell the shares, or ultimately my wealth is increasing. Though I'm not getting in hand, but I can see the share price going up. When growth opportunity is exhausted and no further positive NP projects are available, even matured companies, if they feel like they don't have a growth opportunity available, so they can give it back. How they can give it back? We'll see that one of dividend, other options. But if they do have a lot of cash and they are still following zero dividend policy, so what will happen? Cash will start to accumulate. And if you just have cash, you're not getting anything. So you're losing the opportunity. Then a new distribution policy will be required. Then you have to come up with a new policy, because they don't see any positive projects and the cash is just coming in. You can come with a zero dividend policy. Sorry, a new dividend policy. Last option is residual dividend policy. Again, this is favoring growth phase companies. A dividend is paid only if no further positive NP projects are available. Or we can say a dividend is only paid when all the expenses, operating and capital expenses is done. Investment and financing is done. Then whatever is left will be paid as a dividend. Again, there is no signal. The cash flow is unpredictable, will disturb the planning of the shareholders. Without easy access to alternative source of funds, cash flow is unpredictable for the investors, give constantly changing signals regarding management expectations, similar to the previous one. Sometimes in exam they will say, what do you think about Robobryce dividend policy, and what should be the best dividend policy? Or they can say, what are the types of dividend policy we can follow, and recommend one of them. We can discuss this for and recommend any one of them. I like to know from each one of you, what dividend policy would you recommend out of this four, or if you have any one, maybe fifth in your mind. Before that, we have one suggestion with ratchet pattern, which is widely accepted. So what this guy is saying is, keep a good difference between earning and dividends. Okay, such big difference that even sometime, as you see, earning is going so much down, but still you are able to pay dividend. That means keep high level of retained earnings. And if you are keeping difference, if there is a fluctuation also in earning, it won't affect the dividend. Why? Because you are paying, then increasing little bit, because even if you pay same, shareholders are not very happy because inflation is happening, right? So this is an example of, I would say, constant payout ratio, not constant, stable dividend policy. Stable is closer to that, because constant again will change, but stable is like whatever happening, we are giving the dividend with slight increase. This increase may be 10%, or maybe according to inflation, or maybe less than inflation also, doesn't matter, but every time it is increasing. So if you look from the shareholder perspective, it looks very positive that company is doing good. And whatever problems are coming in the business, still it is not changing the policy, or it is not affecting their dividends. The problem with this policy, as we have discussed earlier also in the first point, that a certain amount of money is always fixed for the dividends. That means you will have less money for investment purpose. Let's say we have got a very good opportunity, a very good project where we can make quick profits, but still we cannot do. Why? Because your money is committed. Okay. So please give your suggestion. What do you believe should be Robobryce policy and why? You have some data to talk. You know our current dividends. You know our competitors' current dividend. And let's say we don't exactly know what is the industry dividend, but let's say it is around 25 to 30%. So which one you will recommend and why? I need it from everyone. Okay, one by one.
I guess I will recommend constant payout ratio. Might be it would be a very suitable for our company. Like we are in IT company, it's unpredictable market. We might see like downfall up. Like we can see like increase in sales as well. We might see downfall in the IT. So I would say the constant would be easier, because if we gain much profit, we can give according to that percentage, and if we like a loss or we have a less profit compared to prior year, we can give them according to them. So it would be my, I guess, appropriate, or else we can follow ratchet pattern, which where we will have like a variable in dividends. It might help us, I guess.
Okay. And you don't want to look at the industry or what the market is doing?
Yeah, I would like to. Yeah. I would. I forgot to mention that point. Yeah, it's
There
better to
might
look
be,
first at, yeah, go on.
sorry, just one point. There might be a lot of shareholders who have invested in both the companies, Robobryce also and Power Robot also.
Mhm. At this time, I guess then we need to also see the industry trending as well, where they are doing. It would be giving more overview of which policy we should decide then. But for me, I'm getting like good feeling with constant or ratchet, because it gave us like not always we need to write or like a stable, where we need to every year need to increase little bit percentage. Might be constant would be easier, but maybe in the long term, if we see we have like so many cash flow coming up, we can rise our percentage, or we can change our policy according to situations as well.
Right. So when you recommend anything and when you're writing an exam, please write. Obviously, you'll justify with the positive, but you can write some downside also of it. Downside can be, like you said, we can even change in the future. But once you change, it will affect their planning, their cash flow. Okay. Yeah. Good job. Yes, Aditi. Aditi, you are saying?
Am I audible now?
Yes, you are.
Since our share price is on industry average now, we can do a stable dividend policy for now. So we can pay one thing and grow it like every coming year. So that might have a positive impact on our shareholders, that we are growing and also we are giving it back to them.
Right. So stable dividend means around 20% you want to continue.
Yeah, so like we can start at 20% and then grow it like by 5% every year.
Right. But if you grow by 5%,
Yeah.
again, we have seen the gearing and everything as we discussed in the previous chapter.
Yes, but that is like the situation now. We have the opportunity of growing with the growing market. So we can predict that because of the growing industry, we might grow exponentially, and with the growth, we'll be able to earn more, and everything will be stable.
Everything should be stable.
Yeah.
Makes sense. But you always have to link it to investment and financing. That is a better answer. Okay. Yeah. Next. Cynthia, be quick, please. Very basic question.
Sorry for the late response. I also think constant payout is a policy that we should adopt because we are in an industry where we need to invest back in R&D as much as possible, considering that our company depends on innovation of new technologies and selling it. So if we, for example, say if we choose stable dividend policy and the profits have been less in a year, you would still need to pay that particular amount to people, even though the revenue you got is low. So I think constant payout would be a safer option. But of course, yes, the cash flows would be unpredictable for the investor. But once if we pay 1 year, if we pay low, it would affect the share price. But still, I think the company can rise up from the fall of share price if they are able to innovate new products and bring into the market, or new software, or any new license or something. Something to distinguish us from the other companies, it would bring the company's name back up. So I think constant payout ratio would be a much safer option.
Okay.
I think this stable payout ratio would be better because we are a company that has been around for so many years, right? So we need to be attractive to our investors, and also we are in an industry that's always growing, that will always grow, right? AI, robotics, this industry will always grow, and we are actually industry leaders. So and because of that, I don't think our numbers will go down if we keep on innovating and investing in ourselves, right? And because we need to be attractive to our shareholders, I think our stable um, ratio would be better, like stable payout ratio.
Hanan, how it will affect our financing and investment if we are going with the stable?
Because we need to basically pay a fixed dividend every year, right? Like a constant. So if
I mean, this. Sorry,
yeah,
continue.
so with a
Continue.
stable payout ratio, we need to be basically um, so we need to pay a fixed ratio every year to our investors, right? Which is basically constant. Um, and because of this, investors will um, invest more in our company because they know that our payout ratio is basically same every year. So this will attract them to invest more.
Yes, that's a good point. The last one, what you said. Invest, and also maybe this can be one of the reason that our share price can come back to normal.
Yes, because our revenue and profit has increased, but it hasn't yet reflected in our share price. And because of that, we need to, I think this would be a good approach to increase our share price.
Right, makes sense. Harish, Jitu, Anam, you can put in text quickly, just a small answer. Jitu, am I audible to you?
Yes, Misbah.
Okay, if some of you are not comfortable to talk, is fine. You can put in the chat. One more thing is very important here is, yeah, we can do stable dividend policy. It can give a positive signal. Otherwise, if we are not having, like in the previous chapter, we see we have problem with debt also because of the gearing, and equity also because of the share price. So maybe we can compromise dividend for 1 or 2 year and use this to invest in a positive NP project. So what will happen? Our share price can go up. So when the share price is going up, we can raise through rights issue and then start giving dividends also. That can also be one strategy. So the best one we can only recommend once we see the question. In the exam, the question won't be directly like this. They will always give a scenario, what is happening. You'll get better idea what to do, what not to do. If you are recommending any 4 of this, or all 4, even if you have 5, the 5th one in your mind, that is also fine. Just justify it, and it should be according to the scenario. Let's say company is saying they need a lot of money for investment, and financing option is not available. So don't say that we should pay 100% of the profit as a dividend. So that will be against the logic. But if you're making logical sense, it should be fine. Okay. Otherwise, there are companies, who have taken loan. For example, Vedanta Group, they're a global company based out of India. They have taken $850 million loan from JP Morgan and Oaktree few months back in 2023 just to pay the loan. So the shareholders were happy. But the problem was their investors were not happy because raising loan to pay dividend was a very risky move. But their response was, we are a listed company and we are in a matured stage. Our shareholders are expecting dividend every year. Many of them are living on that. So they have to take that. So many times, in order to keep shareholders happy, we have to compromise the investor, or to keep investors happy. Investor as in, I said debt investors, or who have given convertible debt or any kind of that. To them happy, we have to compromise with the shareholders, because it's very difficult to keep all stakeholders happy all the time or the same time. Next option we have is, instead of giving out money, we can do scrip dividend. Like, we are not paying them money, but we want to keep them motivated or keep them happy, or at least not angry with us. We can give them bonus share, which is also known as scrip dividend. So what will happen with the bonus share or scrip dividend? There is no cash outflow, but the shareholders will get one extra share. However, the wealth of shareholders will not increase. But scrip dividend is more suitable when you are using the dividend money and investing into the project, because of what the share price is increasing. Then they'll feel like, okay, we have got one more share. Imagine the share price is going down and you are giving scrip dividend just as a replacement of cash dividend. It can be a problem. It can be difficult. You have to communicate then very effectively what is the decision behind it, or else because of the signaling effect, it can be a problem. So what will happen in the financials? There is no cash outflow, but the reserves will reduce because you'll pay from the retained earnings. The number you are showing in the reserve, you have to minus it and put into the share capital.
I just have a question. Do we pay from cash or our earnings. Sorry, this might be a stupid question, but I'm just confused with it.
No, that's a good question. So basically, what you will do, whatever retained earning we have or the profits, okay. So we are saying what is the current share price. Out of the same amount, we'll subtract and put that into the share capital. Getting the point? Let's say we have 100 million and 10 million worth of shares you are giving. Okay. So this will become 90 million, our retained earnings, Hanan, and this 10 million will go and increase to the share capital, which is our non-current asset.
Okay, got it.
So our retained earning amount will reduce and it will go to the non-current. But ultimately, it's just like moving from current asset to non-current asset. Overall assets are same. And the best part is there is no cash outflow. Another option is share repurchase. This is usually in the case we have abundance of cash. We are not finding very good project. So there are two options. One is share repurchase. Share repurchase means we'll buy back the shares. That's what MRF was doing. And a lot of companies who want to increase their share price, they'll keep doing it, bringing in more and more control with limited number of people. Another option with excess of money can be to pay one-off dividend. In one-off dividend, you are paying 100% dividend or more than 100% dividend because you have enough in the retained earnings just to get away with the excess cash. But a lot of experts believe that share repurchase is better because anyways, the shareholders will get the same amount of money, but you'll get back the shares and it will be easier for you to do rights issue in the future. Whereas in one-off dividend, you're not getting shares also, the money is also getting out, and when you do rights issue in the future, again your share price can go down. If you look from shareholders' wealth, the wealth will remain the same in either of them. Any confusion in this chapter? This was very simple. We just have to think about what should be our dividend policy, and in order to conclude what should be the dividend policy, we have to look at the key factors. And in the last one, we have to see if we have to motivate them without cash. That's a scrip dividend. And what to do with extra cash? We have two options. One is share repurchase, and second is one-off large dividend. If you see point number 3 here, share repurchase and one-off large dividends have the same impact on the cash because the same amount of cash outflow is happening. And obviously the gearing of the company because both the money is going out of the equity part. Any question, anyone? I hope if any question comes in the exam regarding dividend, all of you can write comfortably. Okay. Same topics, you just have to explain in your own words. All right. Then next important thing is financial risk. So we have 3 chapters focusing on financial risk. Previously, this 3 chapters was part of P3 under risk management, but now because of financial risk, they thought it should be part of financial strategy, not risk separately. Okay. So financial risk is any risk which is affecting the financials, or we can say the money part or the cash part directly or indirectly. Whichever can affect our cash flows or the financial statements is a financial risk. This can be because of exchange rate, interest rate, credit risk, litigation risk, anything. Okay. And it can be motivated from different factors. Like we have seen in risk management also, one risk which is arising from one factor can lead to different risks. For example, we have got a reputation risk, and because of reputation, we have got loss of sale, and loss of sale has led to financial risk. Or if we have a change in government regulation which is making us to spend more money because of certain compliance, so what we can say, regulation risk led to financial risk. So we have to see what is the source of financial risk, and obviously we have to mitigate it, and this is the most important risk. Most of the risk ultimately will lead to financial risk. When we say the impact, certain risk impact is high, how we decide the impact? In most of the scenario, the impact is high when we are losing more finance or losing more money, right? Or the impact is less where we are losing less money. For example, political risk we have seen. Risk is the risk faced by overseas investors that the host country government take adverse action against after the company has entered. Certain places this can happen when the government is not friendly. And if you are doing business there, they can take over the asset anytime, or they will just support the local businesses. They won't promote the competitiveness. However, this is not done in most of the countries because it is not good for the overall economy to grow. Just like any risk we have seen, financial risk can also be speculative. It's not always that exchange rate can be negative. For example, we have seen in our financials, we and Powerbot both have seen the translation risk, which is on paper. But maybe next year, the translation can be in our favor. So what will happen? That amount will be in positive. We can even gain, isn't it? Because when we do the translation risk under IFRS, we just see the closing date exchange rate. We are not taking the average of the entire year. That's the reporting principle we are following. Okay. All right. Then what came the sources of financial risk? We have few here, but I like to know one from each one of you also. Apart from this, exchange control regulations, supply foreign currencies, restricts residents from buying goods abroad. This can happen, especially if two countries are having conflict. Like in India recently, they are saying to ban Chinese. It didn't happen, but it was motivated. Banning the payment of dividends to foreign shareholders. If you see government news, this is also common. Import quotas limit. Trump government was putting a lot of import quota limit for the Chinese steel, right? Import tariffs could make imports less expensive, or sorry, more expensive, less, what I should say, attractive. Like German cars in India or imported cars in India have to pay 100% tax. That makes it's very expensive. Why? Because to promote the local automobiles, where if you compare this to other countries, they are charging only 25%, 20%. Insist on minimum shareholding. Company structure may be dictated by the host government. For example, in Middle East, they will say they need to have a local Arab employee, not employee owner. And sometimes they'll say it should be 50%, it should be 30%, something like that. These are primarily financial risk arising out of politics, or we can say government. We have not put here exchange rates because exchange rates can be controlled by the government, but they don't go to a very good extent in that, because they also have to keep their currency competitive. Then discriminatory actions can also come. Super tax imposed on foreign firms, restricted access to local borrowings. Just as a rule of thumb, any company who is doing business, let's say we are doing in Darland, or we want to move to a new country, Eastland or Westland, there our logic will say to raise finance locally. But imagine the government is not allowing us. Then expropriating assets, whereby the host country government seize foreign property in the national interest. This is very rare, but this has happened in Africa. Idi Amin case, if you know, a very good example. They thought because of these foreign nationals, their economy is not doing good, which was opposite, which they realized when lot of the people left the country. This can also happen. Okay, now how we can manage the political risk? So obviously this is very difficult and constantly changing, but there are some basic things which we can do to mitigate the risk. One is prior negotiation with the government. Second is structuring the investment. This thing will also change according to the employment levels. Imagine you are going into a country like Darland, which is undeveloped. So I believe the unemployment rates will be little bit higher compared to the developed countries. So what will happen? Government will be little flexible. Why? Because you are giving jobs to the local people. Inflation, exchange, a lot of things will affect. So we can structure the investment in such a way. Like I was giving example of Tesla. When countries are inviting Tesla, they want it to set up a manufacturing plant, not just sales or assembly lines. Why? Because manufacturing will create more jobs. Evaluating the current government's popularity. Whether it is a left wing or right wing, both will have different approach. Like in North Korea, they are just focusing on localization. They don't want anybody foreigner to come and do business. They have a policy, somebody can come, but it's so strict. No company is motivated to go there, right? So what is the popularity? Let's say the opposite government is totally opposite. Opposite as in their policy towards foreign business is totally different. And if their popularity is rising more, so we can wait and invest when the new government comes in. Looking at the historical stability of political system, for example, Nepal, they have never seen a complete government till now. Every 1-2 years, the government will change, and there are other countries also. So this can be even riskier. Then looking at changing religious and cultural attitudes of the people, what is their attitude, how they are, especially to the industry we belong, what is their attitude? We use local financing, taking advice from the company's bank. We might have a bank of Testland, which has branch in Darland, Eastland, Westland, some fictional country. So we can take some advice. Eventual ownership, part ownership can also be there. So we have seen the major risk that is coming from a financial risk, which can come because of the politics or the local government, and how we can minimize them. You might be asked a question in exam saying, we are going into the new country, what do you believe are the major issues and how you can manage them? So one of the major issue, or we can say risk also, is political risk. So these points you can mention as a risk, and the current points what we are discussing you can say as a mitigation. Not exactly, but according to the scenario. So we can even do joint venture with the local businesses or local government. We can do local finance. If you see, these points were repeated in risk management chapter also, we have seen. Gaining government funding. If government is supporting, government is giving grant, that means they will support us because their interest is also there. If we lose, they are also losing. Free trading agreements can be done according to international laws. Planning for eventual part ownership or full ownership can also be decided. Anything else can we do when we are going to the new country? Because we have been discussing this. This is not only political risk, but political risk is the biggest risk when we go into the new country. If you remember, there are other risks also what we have discussed. Can somebody tell me what are the risks when we go for international business? Let's say now Robobryce is going for a market development. What are the major risks? We have discussed politics. What else? Political government risk we have seen.
Cultural, like a workflow or the market analysis. We need to do market, because if we don't know much about the market or the culture of that particular country, we might suffer in hiring employee or settling down our different country cultures with matching up for particular country culture, I guess, like how they even do the works and all, I guess so.
What else? Credit risk is also there. If you remember, we discussed this. If you are giving on credit, it's very difficult to get it back in different countries because of the regulations. What else is the risk when you go international business? Geopolitical issues. Any geopolitical situation arises between the country of origin of the business and where you are doing the business. That can also be a problem. So there can be number of risks which can lead to financial risks. Yeah, government regulation, obviously. Government can change the regulation when the parties change. Okay, what can be the mitigation? They have given some mitigation like local finance, government funding, pre-trading. Anything else? I'll give you an example. There was an tea company, I think it was Tetley or somebody. When they, it's a UK-based company. When they come to India, they did a joint venture with Tata's. Why only Tata's? Because they have a very good, goodwill in the market. Then later on, there are a lot of companies who started with joint venture with them because to utilize their goodwill. And once their brand is doing good and people are trusting them, they just started doing 100% on their own.
Yeah.
So in the starting, joint venture is a good option. Yeah, Aditi.
Another example of is this Hero Honda.
Yes, Hero Honda was a good example. That time, the regulation was not allowing uh, foreign companies to set up as entirely on their own. It was
Yeah.
very strict. You can only do like joint ventures.
And then they came in and then start merged with Hero, and then when they established in the market, they introduced new products specifically on their name. So they established themselves.
Yes, now they are separate. Yeah. How you'll mitigate the risk? This has been asked in the exam. It's very important question. What are the issues and how you'll mitigate?
Making our contract in such a way that there's a specific exit clause, like if anything like that happens, we already have a remedy for it in our own contract.
Contract with whom you want to do?
Like when we have a joint venture with any other company, then there should be an
That is also part of joint venture. Okay.
yeah.
Other than joint venture, any other strategy when you go into the new country?
Can hedging be an option?
Hedging is an option specifically for the financial risk.
Yeah, for financial risk, we can do hedging.
We can also see the demand of the product. Let's say we are exporting current product from Eastland to Westland, and Westland is constantly giving us more business. Let's say our autonomous products are getting good demand there, and we have done the market research and we saw that it will even double in the coming years. So what Robobryce can do, they can think of setting up a manufacturing plant there. Why? Because of the increasing demand. And if you do there locally, we can save cost, and ultimately we can even make some more bespoke products tailored for the needs of the local businesses. So risk will be there, but if we see there is a return, if more business is coming from that particular country, we should choose that country for manufacturing or as a first step to grow internationally.
But Misbah, when any company moves from one country to another,
Yeah.
they usually like first check the market, test their waters, so that like if it's gonna be profitable, if there's demand, who are the competitors, because it's like a big move and it requires a lot of capital. So they do it like most of the companies do it already, right? This market research and all that.
There are agencies where you can outsource and they will do the research for us. So I'm saying on the second step, already research is done. Already our product have been selling there.
Oh yeah, now we are exporting it, but then like moving a unit there or like a second office.
Right. Now, there are a lot of companies. For example, there is one company called Chings in India. So they are getting good result in China and Singapore market also. So when they are branding there, they have changed the name, make it localized, the design of the product, name of the brand, everything is localized. And even they are doing marketing and sales with the local reputed company. But ultimately, they are getting the profits.
Even MACD does that. MACD has some burgers which are like properly vegetarian because of the Indian market and the demand there.
Right. Even Unilever, if you see in UK, is totally different. In Asian market, is totally different. The best part or the most benefit part for us can be if we see the demand is there, if people are ready to buy, and if it is on the what I should say majority side, they can even influence the government. Right? let's say they are ready to buy the product despite government is against it. So they can put a pressure on the government to reduce the tariffs or make it equal for everyone. Or ultimate option is lobbying. You can lobby your own government to have talk with that government, and lobbying is legal. You can even recommend this in your answer. Okay. Usually you just need to write 2-3 points, but explain it. Then second important risk is interest rate risk. We have touched a little bit it in yesterday's class also, because when we pay interest, it can be on fixed or floating. Usually companies will do it equally, or mix of both. This is not upside risk mostly, but they are just doing it as a downside risk management. If you're losing from one, the other part should be covered. Even if interest is not changed, a fixed rate can be a problem for us. Why? Because if interest rate has gone down. Then refinancing risk, that's also discussed. Next is currency risk, is the risk that arises from possible future movements in the exchange rates. So this can be translation and transaction. Primarily, transaction is important. So best thing here, or best example we can take is CIMA. Whichever part of the world you are, you have to pay in GBP. So that is also an example of internal hedging. However, the companies who have more of their asset and liabilities in foreign currency, they have to be worrying about currency risk. But companies who are nationalized, who are just exporting, they don't need to worry much. But in certain cases, you have to take the advantage of the currency. For example, we are doing from Darland. I believe our competitor is also doing from the Darland. They have not mentioned, but if you see our translation risk, both are in negative. That means they are also doing the Darland. Because if they don't, or if we don't do at Robobryce, we are losing a competitive advantage. If we can manufacture same thing at a cheaper, then why we should lose the opportunity, isn't it? Economic risk is any change in the economy, home or abroad. Even abroad can affect, because we are not limited to. Maybe we are manufacturing 1 or 2 countries, but we are sending globally. Or sometimes change in economy of one country can even affect their counterparts. For example, imagine Saudi Arabia or Dubai, the economy goes very bad. I'm just saying in the worst case scenario. So it will affect a lot of people who are working in the Middle East. A lot of people from South Asian countries who are working there. Because some countries, even if you see Bangladesh, Nepal, a lot of their GDP is contributed from people who are working there. It depends on the remittance. I'm talking about the indirect effect, or we can say changes in the oil prices. If you look at the macroeconomic issues, right? How we can manage economic risk, this is very important. This is very important for our business specifically, because we are not an individual industry. We are depending on the economic situation. People can, or companies, when I say people is companies can even sustain without automation, but they are doing it to improve the efficiency, save the cost, and there are a lot of reasons, but they can still survive, especially when the cost is very high and they cannot afford. So this can happen when the economic situation is not good for the country. So we have to be in the countries or in the places where the economic situation is stable or is growing at least. So how we can do it? Diversification of suppliers and customers. Imagine our supplier is facing this economic risk. They are not able to do their business properly. You must have seen international companies, they will have number of suppliers and number of suppliers from different countries or sometimes different continent altogether. During COVID also, this was a hot topic. So there was a lot of news articles. If you notice, they want a supplier of China +1. So they were looking for +1. Why? Because they were overly dependent on China, like a world's factory. Then marketing, even in marketing, there is a chance of your business going up, especially if it is for the need, if it is related to basic needs. Let's say the FMCG and this companies, these are basic necessities, food, clothing, and everything they are giving. or even in medicine, we can say. So not everybody can grow, but some companies who are utilizing to do better marketing, or they are giving at low price plus good quality, their business can go up more in economic crisis than in the normal situation, because the demand for cost leader products. What are cost leader products? Whose main advantage is they're giving the utility, they are for the use but at a lower price, whereas differentiator is use plus it gives some higher perceived value. So cost leader can be more successful in economic crisis. Diversification of financing is also important. We should have our currency, for example, it can be done at a macro level also. Like in Middle East, they have tied up their currency with the US dollars. I think it's 3.65 something, depends. UAE is different, Qatar is different. Aditya, sorry, I didn't see your question. You're saying, is there a word limit for the answers? No, in exam, there is no word limit. The more you write, the better it is. In fact, some publications will say that you write one paragraph for 1 mark, but I don't agree with it, because it's almost impossible, or it's very, very rare somebody is writing such a big answer.
Yeah,
Because
there's
for
enough time for it, right?
I mean, you cannot write 50 paragraphs for one answer. That means you end up writing 150 paragraphs in
Yeah.
3 hours. That's almost impossible according to me, because you have to think, you have to analyze, you have to read, you have to structure, you have to think. Most importantly, it's not just like you have learned and you are writing. The entire 3 questions is like a story, connected story.
Mm. Okay. So like,
I usually recommend to write one paragraph minimum for 10 percentage. Let's say it's a 50%. 50% of 50 marks, that's 25 marks. So you can write at least 5 paragraphs minimum, because some other publications are saying one paragraph you can get up to 2 to 3 marks. So from that criteria, that is more practical. We'll see more when we come to mocks. Okay. But
Okay.
the answer to your question is, there is no word limit. You can write as much as possible.
okay.
Our quality should not reduce when you are just focusing on the quantity.
Yeah. Makes
In
sense.
fact, the problem is a lot of people are failing because they have unfinished answer. They are not able to write.
Yeah. I think it's more like, if you give the complete answer, like whatever they are asking, you are explaining every bit of it in concise form.
Yes, for example, they ask you how to minimize economic risk, and the question is, let's say, only 30%. So here we have 4 points. Maybe you have written only 2 points or 3 points. That's also enough. It doesn't expect you to write all 4, but out of these 4, you have chosen the best 2, considering the question, because question will have a story, a background, why that issue has come up. They'll always give you an attached material. If you have seen yesterday's question, what I shared on the group, you'll understand. Everywhere there's an attached material.
Misbah, this is ACCA paper, right?
No, this is a CIMA one.
ACCA June 2003 examination. This is some Kalpan publishing.
No, that is a CIMA paper only. Maybe
Oh.
there is some printing. Yeah. You have seen it's for Robobryce only. Have you
Yeah.
read it completely?
Not completely. I was reading it, like how the questions are, what materials they are giving, like how the structure is. Like I have a hint of it, like because it was a
It is
part of science.
Kaplan only. The Kaplan is a publication, and it is for CIMA only.
Okay.
That
Thanks.
publication too for ACC also, that's a different thing. So read at least one mock completely and one answer. It will give you a lot of idea.
I'll do that today, and I have some like doubts. I'll ask you.
Okay, sure. Then transaction risk, as you have discussed, buying or selling. What happens if you buy something now? We might buy on credit, or our supplier might give a certain credit. When we are giving them the payment, there is a chance of the currency going up and down. So that is known as transaction risk. This will not happen when you are doing in cash. But in business, cash means I am saying immediate. But in business, most of the transaction is on credit. There is a danger that between the time the transaction and date of the cash flow, exchange rate will be moved. We'll see how to mitigate that. Then second is translation risk. This arises when a company has assets or liabilities denominated in foreign currency. For example, for us in Darland, you might have some cash at bank also there. The risk is that exchange volatility will cause the value of asset to fall or liabilities to increase, resulting in loss to the company. However, translation risk is not the actual loss, but it's just on the paper. Maybe on that day or that week, the currency was going down. Please read these chapters. This can be confusing actually. They will not ask technical questions here. In fact, the coming 2 chapters are very technical. They just ask you the basics. What about translation risk? They are saying it doesn't affect the value of the entity as a whole. It can affect the attribution of the value between different stakeholders. Like when we analyze, we saw or showing the loss. Higher gearing may lead to higher interest rates being charged on the bank loans, either directly in accordance with the clause or in the borrowing agreements. If the accounts are being used beyond their design specification, there is a temptation to protect current CS figures. But sometimes if the management's remuneration is depend on this translation risk and all of this, they'll try to do something to reduce it. One more risk you please make in your risk list is higher finance cost. We are paying a very big amount of finance cost. One of the reason can be because of higher gearing. Because of higher gearing, we have to pay higher interest rate. If our gearing reduced, there is a chance we might reduce it by 0.25 or 0.5%. If it is 10, we can make it 9.5, like that. Okay. Next is value at risk. So this concept of value at risk, usually it's not directly tested because on individual paper for understanding. This concept is all about, we don't need to know the percentage. Let's say 10% chance of loss is there, but we want to know the actual value that we can lose. This is primarily done by banks and bigger financial institutions. Let's say a bank is giving money to Robobryce. Let's say 100 million. So they'll say out of 100 million, there's a 5% chance that we might not get the money in the worst case. So they will see the value of 5%, how much it is coming. And they'll say, is it within our risk appetite? If yes, we'll give the loan. If not, we'll not give the loan. And how they arrive to this, they have probabilities. And how they get the probabilities? Through data. And how they get data? Different sources. So 2 banks can analyze the same thing with a different risk. For example, one company 100 million, they'll say 5% risk. Other company, same amount of loan, company as in bank, they will say 6% risk. This depends on time period, confidence level, loss amount or percentage loss. If you want to understand the calculations, I can share your video. But this is not asked directly in our exams. Okay, any question? So chapter 8 was introduction to the risk, financial risk. 9 and 10 is the mitigation. So 9 is smaller and interesting also. If you can just stay with me for 10-15 minutes, we can finish it. Okay. Now currency risk management. How we can manage? We cannot just make the risk. When I say you to make risk list, it will be incomplete if you don't put a management of that or mitigation of that. Management is mitigation. And remember, risk cannot be avoided. It can only be mitigated or reduced. If it should be avoided, then we'll not read this subject also. We don't need to study risk management. And we can avoid only in a situation when you don't want the return. If you want the return, you have to take the risk. So there are some basic terminologies. I hope all of you are aware with what is exchange rate, what is spot rate. Any confusion? Inverting exchange rate, spread. Spread is basically banks. For example, if bank is buying from you, they'll buy at a lower rate. And if they are selling to you, they'll sell you at a higher rate. I hope all of you have experienced. Why they do it, bank? Because they are there for profit. And what it is known as, the difference is known as spread. Then cross rate. Sometime you might not know directly. For example, from dirhams you are doing to pounds, but you don't know what is the difference between dirhams to pound, but you know from dirham to euros, then euros to pounds. That is cross rates. Cross rates we can use to find the conversion. So one of the technology, not technology, one of the method we can use to find or mitigate this risk is to forecast the exchange rate. For example, if the geopolitical issue is happening or certain country is going in war, so we can see their currency might reduce or will reduce. That is one way of forecasting. That is extreme situation, but even a normal situation we can forecast exchange rates. This kind of job is usually done by the banks. Companies like us will not go in so much of detail of doing this, or we might outsource it if we do also. Companies whose profits are so much depend on the exchange rates, or they are so much into import exports, they might need to do this. Okay, why we need to do it first place? If we have foreign debtor and creditors, payables and receivables, basically our working capital is affected with this. Pricing. Why pricing? Pricing, this is the most important. Let's say you have fixed the price to sell something on $2,000 as an example, and your supplier is in different country, and your supplier is constantly changing the price because of any reason. So what will happen? You have to pay more, but you cannot increase the price. Can you? No, because you are fixed. So you have to see how you can deal with it. So you can forecast the exchange rate. So you can go in a contract with the supplier and say whatever happens, but for this particular period, you will be giving us at this price, right? So it's very difficult for us to go and change the price to our customers or the other businesses, or sometimes the consumer directly. Then investment appraisal of foreign subsidiaries. If you're investing there, then also we need to know. This is a little bit of economics also we can say. And why any exchange rate fluctuates, or why there is a change in forex. First is speculators. The speculator is the thing. Second is balance of payment, foreign trade deficit of the government. Third is government policy. Many countries government purposely want to keep their currency low because of the advantage. For example, China, they can increase their currency, but they are still maintaining it. Japan is such a developed country, but still their currency is even lower than India. Why? Because it benefits them in the trade, right? So like this, government policy can have a serious effect on it. But once the government policy is set, other things like balance of payment, speculation, then capital movement between economies, this will affect the currency. And again, if I go back to the Middle Eastern countries, the government has done a good job that tying up with the US dollars, because majority of the international transaction is done in the US dollars. Majority of the reserves are in the US dollars. So if they're tied up with them, they don't lose much in the forex. They are also doing business, but the private businesses operating in their country also. And there are certain theories. These have never been tested in the exam, but just as an idea we can see. First is purchasing power theory. So what it says is law of one price. Identical good must be cost the same. So if you're buying, let's say 1 kg apple in Dubai and 1 kg apple in London, it should be the same. If it is not the same, people will start buying cheap and selling expensive there. And ultimately what happened? Everybody will try to do that and the price will become same. And when we say it cannot be 100% same because of the government policy, import tariffs and lot of regulations. So we can use this theory to come up with the exchange rate. Second is interest rate parity theory. So what this is saying is interest rate is made up of two things. One is about the inflation plus whatever the bank's profit is. For example, bank is charging you 8% interest rate. So maybe bank is earning only 3%, 5% is the inflation rate. So interest rate parity theory is also there. But remember, all of this can be motivated by the government. Third is international Fisher effect. Claims that interest rate between differentials between two countries provide an unbiased predictor of the future. So they are saying if the inflation is higher in one country, for example, so automatically their country's currency will go down. And if certain currencies inflation rate is very low, their currency will stay strong. Best example here we can say with Turkey. What happened with Turkey during COVID and even now, their currency has gone down so much. Why? Because of the inflation. The inflation was how much? 30%, 60%, even more than that. People were just putting their money in asset. Even they are buying cars and gold or whatever they can, because whatever money they have today, tomorrow its value is reducing. These are very logical point which can affect the fluctuation. But the problem with this is anything major happen, then only we can do this. If there is a small fluctuation, let's say 0.5 or let's say USD to GBP, if there is let's say a difference of 1 GBP or $1, it cannot be easily predicted in this thing. And that same thing when we go into million and billions, which will affect a business to a very great extent. So this can save from major risk, but very difficult for the smaller risk. Does it make sense? Hello?
Yeah.
Yes.
This can be very helpful to you beyond the exams. You can even do some research on this. Especially if you want to work in banks, this skill will be useful for you. Arbitrage is also there. Is the simultaneous purchase and sale of security in different markets with the aim of making money, making risk-free profit. This is also exploitation of prices. The first one. If there is a difference, arbitrage will happen. Sometimes some companies are so unethical. What they will do, they'll buy things for cheap and artificially they'll increase the price because they're in the developed country. People are rich, they can afford by just doing very fancy packaging or some kind of marketing. But they are legally correct. They can find loopholes. So there can be an issue of ethics there. And we have 1 second. How much is? Do you want to continue? It will take another 15-20 minutes. I was thinking we can finish, but it's quite big. Or we can do in the next class. Whatever you guys suggest. Hello?
Either way is fine for me.
Same. I have no problem.
Others? Anam, Hanan, Nikhil? Okay, let's continue. How you want to do next class? Let me see. Let's continue, guys, if it's okay. Because we need to do a lot. E3 is also there. And the problem is in Thursday's class, we didn't do much. All right. Won't take much time. So financial risk management. First, we have to identify the risk. Just like any risk, we have to identify it. Second is quantify exposures. Quantify, why quantification is important. Based on the quantification only, we can see the impact it will do. If it is a small, let's say PT expenses, doesn't need to do the management. Decide whether or not to hedge. What is hedging basically? We'll see the definition. Then implement and monitor hedging program. So hedging is, or it can involve reduction or elimination of financial risk by passing that risk on to someone else. Hedging is nothing but management of financial risk, we can say. I would not agree with elimination completely, but it is managing. By managing, sometimes you can eliminate, majority of the time you are reducing. That's the primary meaning of hedging. Hedging can be internal, hedging can be external. We'll see that. What can be the advantage and disadvantage? Whenever you are using certain techniques or certain terms, we have to use or we have to take help from certain stakeholders. And when the certain stakeholders are involved, they have their personal interest. So one con or one disadvantage of any of this is cost. It will be expensive. Even if it is a small fraction, it is an extra cost on the organization. So risk management is also a costly affair. It's not easy. Therefore, a lot of companies who are not big enough, they will not take it seriously because they feel it's expensive, or maybe they feel like the risk is not very high. Therefore, quantification also we have to do. If I go with the positive first, hedging and provide certainty of the cash flows. Maybe we are losing on the upside, but the downside is also done. For example, we are putting half interest in fixed, half in floating. Let's say we have completely on fixed and suddenly interest rate goes up. We are advantage. But we don't want to do that. We want to do it fixed because we want certainty. We will need something fixed. Then risk will be reduced and hence management be maybe more inclined to undertake investment projects. We are taking a lot of risk when we are investing into the project. Why want to take risk from every sector? Just take it from few and focus. Reduction in the probability of financial collapse. This probability is also mitigated with this. Then managers are often risk averse. This is very important for managers when it comes to their personal. Some people can be very risk taking when it comes to companies' money, but when they need to give their own money or their own remuneration, people are not taking risk. What can be the disadvantages? Disadvantages is shareholders usually don't invest only in Robobryce or any one company. They might have diversified already. They might have hedged already. Let's say they've invested in Robobryce also, PowerBot also, or ABB also in the real world companies. Then transaction cost associated is expensive, as I said. Lack of expertise. We need a separate people, separate team to handle this. Even in finance is like an ocean. Audit is totally different, reporting is totally different. Within audit, we have internal, external. Within internal, external, we have people who are expert in software based, who are with physical, who are with sampling, right? So we need expertise specifically for this. Why we need expertise? Because it is complex. So shall we have it or not? We are saying pros and cons. So usually it's good to have, especially companies like us. I would say it must have hedging. So what companies can do when we talk about expert, they can have a separate treasury department. What does treasury department do? In certain companies, you might have seen finance department will do this, but in certain companies within finance, they'll have a treasury function. It is there in every business, but sometimes a separate department, sometimes within the finance. What they do, managing relationship with the banks, working capital, liquidity, cash flow, long-term funding management, and currency management. Obviously, this will increase and decrease according to the business model. This is important. Sometimes they'll ask how we can mitigate the currency risk. So these options you can write in your answer. First is internal hedging. So best advantage of internal hedging is it's cheaper for us. Why it is cheaper? Because third party is not involved. First option is invoice in home currency, like CIMA. I gave the example. CIMA, ICCA, a lot of other businesses which are part of the world you are. They ask you to pay in their local currency. They are not getting any benefit, but they are not losing also. And usually these currencies are very stable, or sometimes it might be in, let's say, Nepal or some part of Africa. They'll say pay us in US dollar because US dollar is more stable, like that. Leading and lagging, this is very logical term. If they feel like today the conversion rate is in their favor, so they can request to pay early, or if they feel today the conversion rate is unfavorable, so they can request the other party to wait for a certain time. So leading and lagging, obviously this should be part of the contract and should be done with the consent of other parties involved. Otherwise it can have contractual inadequacy risk. Third is matching. What we can do is asset and liabilities in the same currency, payables and receivable in the same currency. What we have done in floating rate and fixed rate interest cost. Okay. Third one is netting. Netting normally involves the use of foreign currency banks. We can take a foreign currency banks. Let's say we are in $, but we are taking help with US dollars. So they can help us to reduce the currency risk. Then pooling also we can do. When a business has several bank accounts in the same currency, what they will do at the end of the day or end of the week, however it works, everything will come into one account. So if you have some extra cash in one department or one sector, it can be used to pay for the other ones. We are not looking at department wise or section wise, but the entire test Robobryce group will be together, leaving a zero balance on every account except the central account. All money will be kept in the central account. Counter trade, this is an example like barter system, like in the earlier days. If somebody is providing a certain service, we'll not pay them, but we'll also provide a goods or service of the similar value. Any confusion?
No.
Okay. Second option is external hedging. Again, netting center is here. Here we have professional financial institution which can help us to do this. This is expensive, but cheaper than not hedging, right? It's a good way of risk management, and it can give us certainty of the cash inflow and outflow. Then we can do forward contracts. For example, we are going for the deal today, and the supplier will need money after 3 months, or will get money after 3 months. So we can fix today also, whatever the transaction. It doesn't matter what will be the actual rate that day, but today, let's say in January we are fixing for April or May. I'll pay you by this US dollar test land is this dollar, and we are fixing on this. It can be on premium, it can be on discount. Premium means it can be little higher than today, or it can be little lesser than today's transaction rate, doesn't matter. If both the party agrees, it's done. There are advantages of that. Very simple. Please read this chapter again, okay? Simple and low transaction cost can be purchased from high street bank. Very common practice. Second is money market hedges. So usually the same technique they are doing at a wholesale, at a bigger level. So here also they are using the what we did similar terminology what we did in internal hedging, liability and assets. If they have something in this currency, they'll have payables also there in the same currency. But here we can do it with the help of the financial institutions. They have given certain rule. Rule is not ask, but for your understanding, you can just read it. Okay. What is the process in case of making payment in the future? Borrow in domestic currency, buy the present value of future payment today. So we are just fixing for the future payment and receipts. One disadvantage is common. These things are complex. This thing is expensive. What are the advantages? No currency risk because exchange take place today. Fairly low transaction cost compared to the other one. Okay, it's expensive but comparatively low and gives a flexibility. Then we have currency futures. Futures are derivative contract and as such can be traded on future exchanges. The contract which guarantees the price of the product. Sometimes what happen, we are just fixing the translation, not with that party, but with the bank. I need $1 million in this day. That's it. And we can use it for any transaction. Like USD to GBP, USD to Euro, anything. What are the advantages? Offer an effective fixing of exchange rate, no transaction cost. No transaction cost later on, okay? Are tradable. Sometimes you can sell it off also. Disadvantage, must be used for GBP futures, require upfront margin you have to pay. The middle person, the bank, the financial institution, they are doing for their own money, right? So they need to be paid. They're not usually for the price tailored amounts that are required. Maybe the 1 million what you have done, you might have used only half of it or 90% of it. But you have to pay premium for the embryo. It can be used when you are buying also, selling also. Ticks is basically the points. This is used in calculation. This is the terminology they use. If the conversion from USD to GBP is 1.7120, so this 20 they can say ticks like that, last 2 digits. Usually how currency is written, the first word, point, then up to 4 digits. So this tick means the last 2 digits. 15 means last 2 digits. Or if they say 120, so 120 ticks like that. Just for the reference purpose. In exams, the question will be very simple. They'll ask you what are the financial risk mitigation options we have, or how to mitigate financial risk. So you can give some options from internal, some options from external, or sometime they'll ask you specific. What are the internal mitigation techniques we have, or what are the external hedging techniques or external mitigation techniques? Out of this, you can write 3, 4, even 2, depending on the quantity and depending on the scenario. When you are making a risk list, you just write these options. And if you revise that, it should be fine. Okay. Then we have another one, that is currency options. So the word option means it's an obligation. Previous one is kind of obligation because you are paying in advance. You are fixing it. But here is an option. So you'll only use when it is in your favor. If it's not in your favor, you won't use it. So here the upside potential is also there, and downside potential you have mitigated. But the problem with this is it is very expensive. You have to pay extra premium there. Why extra premium? Because this also allows you to use the upside potential. Advantages: offer the perfect hedge. There are many choices to strike price. The option can be allowed to lapse. Disadvantage: traded sterling currency options are only available in foreign markets. So basically, individual currency, high upfront payment. These are cost. One point you can always remember when they say disadvantage, it's a costly one. And advantage is it's a best risk management, or the best risk management what companies usually use. You have given the steps how it works: setup, hedge, pay upfront, transaction, details, all of this. And there is some terminology in and out of the money, just for the understanding. In the money is when it is favorable. Out of the money means when it is not favorable for the company. So when it's in the money, let's say it is in the money, so we'll not use this option. Why? Because we can get upside. When it is out of the money, we can use the currency option, exercise the option. It is called exercising the option. Then we have Black Solace model also. So here also they are trying to calculate the fair value of the option, how much we need to pay it, what techniques we can use, like that. Then we have swaps. Swaps, I'm sure you guys have heard already. This works in interest also and currency also. We can just swap the currency altogether. It can be done with the other businesses. Let's say there is a good Tesla and a business who is in different industry working in Ireland, and if you need money, we can swap with them. This can be done with a middleman, which is usually a bank, or maybe between both the companies also directly. Whatever they are giving, they should return in a different currency. And at the end of the period, it can be swapped back also. But generally, it can be done with the bank. Okay. Same thing can be used with the interest rate swap. We'll see that in the next chapter. So you have seen almost 6 to 7 options for internal hedging and similar for the external hedging. So what you need to remember, I know it's a little complex, we have not gone in detail because it was not required. You should know while maintaining or mitigating financial risk, we have 2 options. One is internal hedging and external hedging. And internal hedging includes these points and external hedging includes this point. You should just be able to understand the definition of it. That's it. All right. Any question? I think you'll have question once you read this.
Not at the moment. If I will contact you.
All right, great then. So in the next class, we'll see the remaining chapter of the interest rate risk management. Okay.
I have just one question. Are we having a class on Thursday?